It's time again for a quarterly review of the market. So let me first start off by giving you a roundup of the events that happen in the market, as well as some of our views on how it may impact us as stock investors, before moving on to sharing with you guys on how our TJI portfolio performed. Alright, so let's begin. First up, we have the race to achieve herd immunity and the gradual opening up of economies. With this progress, travel stocks may potentially see some upside in the next few quarters to come. But there will still be uncertainty due to new variants of COVID and resurgence of cases. Alright, next up we have the global minimum tax rules. On 5th June, the G7 leaders came to an agreement to back a global tax reform plan to set a minimum global tax rate of 15% for large multinational companies. This move under the Biden administration came as an attempt to tackle the abuse by large multinationals which seek out jurisdictions with lower tax rates. So some critics called this the race to the bottom, as countries compete to provide the lowest tax rates to attract the large multinationals. And Ireland is one of those countries. The scope of companies that fall within the net has not been finalized, but it is expected that the tech giants like Facebook and Amazon will be part of the scope. And this rule has not been enacted yet. It is still set for discussion by the G20 leaders. So this is how I view this matter. In the short term, this global tax reform plan should not pose a big issue for stock investors, as it would typically take some time for new tax rules to be enacted, should the tax reform eventually go through. The global tax reform, if set in place, will reduce the after-tax profits for the big tech giants. Goldman Sachs and Bank of America have also estimated a negative impact to the EPS of about 2 to 5%. So if the tech giants continue to sustain high growth rates and sound performance, the impact of the tax reform may not be considered to be that significant. Further, we can also anticipate that companies may come up with new tax optimization strategies that could possibly reduce the impact. Another event that got many investors worried is the rise of inflation. The rollout of vaccination boosted economic recovery, which has led to inflationary pressures. So for those who are wondering why stock investors are so worried about inflation, let me share with you. When there are inflationary pressures, the Fed may intervene by raising the short-term interest rates so that it becomes more expensive to borrow money for consumption. So when interest rates increase, the prices of the stocks will theoretically decline, which is what many investors are worried about. There are many news articles reporting about inflation, and some of these articles use words like wake-up call, top risk, which can induce a lot of fear in investors. These are what I consider as market noises, which will inhibit rational thinking. You may have also come across articles with differing views that can confuse you as to which stand to take. Do not be scared off by such news articles, as they are just market noises. What we can do is to stick to our investing rules by investing in only quality companies, so that no matter what the market throws at us, we will still be able to perform well. In fact, if prices decrease because of the Fed raising the interest rates, that may present as a good buying opportunity for us. So it is not something that we should be that fearful about. At the start of Q2, the Chinese regulators slapped a US $2.8 billion fine on Alibaba Group. In my opinion, this is a good update to the antitrust investigation saga for Alibaba. And our view is that having known the downside is better than an exposure to unknown risk. Our conviction in Alibaba is not impacted by the antitrust regulations, as many tech giants, including the US counterparts, also have their fair share of regulatory issues till today. Instead of panic selling, we capitalize on this situation by buying more positions at a good bargain price. Last on our list is the heightened level of speculative activities in the stock market. Meme stocks are taking the stage once again, with stocks like AMC rallying up as high as 95% in a single trading day. Then we also saw Bitcoin prices plunging down after a tweet by Elon Musk. We've shared with our community on our Telegram channel and Facebook page that we should not be making our long-term investing decisions based on short-term speculation or some random tweets. Always stick to our investing rules. Buy quality companies. Make investments that you have conviction in and not based on herd mentality. In the coming quarter, we may continue to see meme stocks in action and more people sharing about their millionaire success stories from buying those meme stocks. Perhaps you may feel tempted to try it out, but always ask yourself this question. You may, for example, be happy to earn that 30% in a single day, but are you as mentally prepared to lose the same 30% in a single day? Alright, so that's a roundup of the key events that happened in the market in the recent quarter. If you want to get more up-to-date notification of our views on the market events, you can follow us on our Telegram channel and Facebook page. We just had May in the recent quarter, and one famous saying we always hear is, "Sell in May and go away." Some investors have been staying on the sidelines and waiting for year-end to come back into the market. Let's take a look at the monthly returns of SPY from the last 20 years to see if it's an advice that's worth following. If you look at the red shaded boxes, over the last 2 decades, there's just a small handful of years you will thank yourself for trying to get out in May and to get back in November. For some years, in fact, it was generally simply bad all year round anyway. So as investors, we must look at the facts instead of listening to old adage that may not hold true. So how did our TJI portfolio perform in the last quarter? In Q2, we saw a total return of 169,000 and for year to date, 341,000. This translates to a 15.9% ROI for Q2 and 48.5% for year to date return. This is the total return from both our Interactive Brokers and TD Ameritrade accounts. Let's now take a look at how the major indices have performed. In the second quarter, Nasdaq has started to catch up with the S&P 500 and has performed better than the S&P 500. Because the technology sector, which has not been performing that well in Q1, has started its rally up in Q2. For the China side, the performance for Q2 ended slightly below Q1. To put things into perspective, we should always compare our performance against a benchmark. Because if we cannot beat the benchmark, then we'll be better off by just passively investing in the ETFs itself and save on all the stock picking effort. So our portfolio is up by 15.9%, while the S&P 500 was up by 7.4%. Dow Jones was up by 4.2%, Nasdaq up by 9.7%, and lastly GXC down by about 1%. And this is the year-to-date returns for our portfolio versus the ETFs that track the US and China market indices. This is also why we prefer to stock pick compared to investing in only the indexed ETFs that are in the US or in the China market. There are merits or certain occasions for buying indexed ETFs, but not in a time whereby in the US the market index overall is not that cheap. Recently, we also did a video on that we can do more than just investing in only indexed ETFs, so feel free to check out that video. Looking at returns alone is not meaningful because we don't want to achieve high returns at the expense of taking up higher risk. Risk management is something that many investors tend to miss out on. So let's take a look at how our portfolio performed in terms of the risk areas. We'll be looking at the risk measures for year to date and not by quarter, as it is more meaningful to have a larger data set to analyze. Alpha is a measure of the portfolio returns. In particular, the excess returns earned on an investment above the benchmark return. So if alpha is positive, it means you managed to beat the benchmark. Here we see that alpha is 44.6% comparing against the S&P 500 as a benchmark. Beta, on the other hand, measures how closely a portfolio will move together with the market as a whole. Having a low beta means in relation to the market, our TJI portfolio has low correlation, which protects our capital from huge drawdowns during market decline. This means that whether the overall market is doing well, remains stagnant, or is making losses, it does not mean that our Moneyball portfolio will follow as well. Perhaps let me illustrate with 3 different scenarios on what it means by having a low correlation with the market. The first scenario is when the S&P 500 is heading up from end March to end June. In the same given period, SPY was up by 10.8%, while portfolio was up by 22.6%. The second scenario is when S&P 500 is heading sideways from 4th Jan to 4th March. SPY was nearly flat at 0.8%, while portfolio was up by 11.5%. The third scenario is when the S&P 500 retraced down. In the last 6 months, we do not see prolonged period of retracement for S&P 500. So let's take a look at shorter retracement periods from 1st March to 4th March. SPY was down by 1%, while our portfolio was down by 2%. In another example for retracement from 14th June to 18th June, SPY retraced by 1.9%, while our portfolio was up by 2.8%. So as you can see, by carefully picking stocks and employing options strategy, this is how we manage to achieve alpha to beat the market while maintaining a low beta or correlation with the overall market. Sharpe ratio is a measure of risk-adjusted return. Sortino ratio is just like Sharpe ratio, but it's an improvement as it considers only the standard deviation of the downside risk. Because we don't like volatility as a result of downside risk. But if it is upside volatility, that is something beneficial for investors and not something of a worry for us. The higher the ratios, the better it is, and the ratio above 1 is considered good. Our portfolio performance is based on our Moneyball methodology of scouting for stocks that are fundamentally sound, acquiring undervalued stocks and selling them when they are overextended, and also employing option strategies to mitigate risk or enhance returns. Let's now take a look at the mini portfolio that we started at the beginning of this year. So for the mini portfolio, we're up by 13,000 USD. That translates to a 22% ROI for Q2. Year-to-date ROI stands at about 43.8%. So we applied the same Moneyball methodology for this mini portfolio to illustrate that our methodology works just as well for a mini portfolio that we started off with only 37,000 USD. These were some of the trades we made in our mini portfolio. Being a smaller portfolio with lesser available funds, position size are scaled down, but as you can see, it doesn't matter. You can still make the same good returns. We don't compare this mini size portfolio absolute returns to the usual portfolio we have. We don't compare this portfolio's chapter 1 to another one that is already at chapter 6. For any investors, just focus on the return of investment of your own portfolio. The important thing is to learn how to grow your wealth. Even if you just earn a 20% on a $10,000 pool of funds that gives you $2,000 of returns, that number may not be life-changing, but it is the skill set that matters. Because all big things have to start from small beginnings. Part of our methodology is to understand that the market moves in cycles and that different sectors will have its time to perform and shine. In the first quarter, the technology stocks were not doing well, and that presented us with the opportunity to buy more of the good technology stocks, which will eventually rally up. And that materialized in Q2 as we saw the technology sectors catching up. In both Q1 and Q2, we have also been adding more positions of the China tech stocks such as JD.com and Alibaba at bargain prices as we saw attractive potential upside. These Chinese stocks have not been doing so well now because of the antitrust regulations and also because China is the first major economy to be cutting on the pandemic stimulus. In the short term, your portfolio may be sluggish if you have been overweight in China as compared to US stocks of late. However, we remain bullish on China in the long run, and the opportunities presented to us now in China is just like what COVID gave the stock markets in 2020. So as investors, we should have a long-term view of things even if it may ever mean underperforming for a few quarters, so that over a year or two, it may eventually play out to be the better decision. But we cannot do this without cash. And as retail investors, we are all faced with the same challenge of having limited capital to invest in. This is why we will trim some of the profit-making positions from time to time to raise cash to buy more stocks when the opportunities arise. In our public Telegram channel, we have also shared that we trimmed down positions for stocks such as Adobe, DBS, MasterCard and Costco to raise cash to buy more positions of the stocks that have better upside potential. When we trim down a position, it doesn't mean that we necessarily believe it will go down, but it could be a case of spotting a better opportunity elsewhere, or that we believe the upside is getting limited in the short term. We may also buy back into the same stock if an opportunity presents itself again, like in the case of Nike and Amazon too. We also want to put it across to some of the comments that may have misunderstood what we have been trying to say or what we are doing. We agree that it is not possible to time the exact top or bottom, and we also never said that we did it too. But it is definitely possible to make educated decisions by taking calculated risks to enter or exit in a manner whereby we will be able to earn reasonable margin for profits. We don't need the exact top or bottom in order to earn a comfortable returns. If it happens, that's a bonus. Otherwise, we should be able to earn a return that is healthy enough. So all this that I shared are part of our thought process and our Moneyball methodology of making more efficient use of our given capital to beat the market consistently over the last 6 years. This is a quick snapshot of our track record since our Moneyball portfolio incepted in 2016. With 48.5% year to date, we look on track to achieving our average returns on an annual basis. We will remain bullish, especially on the China markets, but will be cautiously bullish on the US markets as it has already run up by a fair bit for the first 2 quarters. Also, a few months back, we started rolling out some private closed-door classes for my own group of friends and those who wrote in to us. The feedback was good, and I'm happy that they have learned how to fish for themselves to earn some side income alongside their full-time work. This is also one of the screenshots from one of our students who shared that he bought Domino's stocks at 339 when there was a good buying opportunity after the earnings call, and he eventually trimmed off the position to raise cash for other stocks. Some of you have also written in to ask whether we'll be launching our classes to the public soon, and I can confirm with my team that yes, we'll be doing so in the weeks to come. But as our classes are conducted in the form of a small focus group setting, we will not be able to do it that often to ensure more quality learning. For those who wish to be in the loop, you may drop us an email as well at hello@thejoyfulinvestors.com to get priority alerts, and my team will take it from there. We may also blast out the details in our Telegram public channel. If you want to stay in the know for more investing tips, do subscribe to our YouTube channel, and for more timely updates and deeper understanding of our thought process, you can also subscribe to our public Telegram channel where we share with you more frequently on our investment decisions and market updates. However, please do not take what we say or do as financial advice, as it should not be, and you should be doing your own due diligence. With that, I shall sign off and see you again in the Q3 portfolio update.